What I think was perhaps most troubling in Standard & Poor's report released on Friday, outside of the headline downgrade, was the negative outlook. The fact that you've said, look, between the next 6 and 24 months, if we don't see substantial change, the United States faces yet another downgrade. How would you assess the possibility of that? How great is the percent possibility of that as things stand now? What would drive it, and what would prevent against it?
Sure. Well, a negative outlook means that we think there's at least a 1 in 3 chance that the rating could move lower again. And we cited 3 main factors here. One is the future path of economic growth in the country, because that's going to have a big impact on the future path of public finances. As we all know, the recession, it turns out, was deeper than was previously assumed. That was confirmed by the government the week before last. And the path of recovery has disappointed. It's been a subpar economic recovery thus far. And of course, against a background of some degree of fiscal tightening, and also against a background of turbulence in the global economy and perhaps slowing economic growth elsewhere, there are big headwinds facing the U.S. economy ahead. So that could impact public finances. This agreement and how it's implemented that Congress and the administration came to last week could also have an impact here. If, for whatever reason, there's some backsliding on implementing the $2.4 trillion fiscal consolidation plan that was agreed last week, that could have an adverse impact. And finally, there's the future path of Treasury interest rates. We think that they're likely to remain relatively low. But to the extent that there was upward pressure on interest rates, that would also impact public finances. So those are the factors that we would be looking at which could drive potentially another downgrade. On the other hand, there is some upside to this story. It's possible that this plan will be implemented in full. It's possible also that the administration will be able to persuade by next year, Congress to, do what the administration wants to do and secure some extra revenues from high-income taxpayers. That could also enter the mix, in which case the outlook could also possibly revert to stable.
Looking historically at countries that have lost their AAA credit rating and have subsequently gained it back, it's taken anywhere from 9 to 18 years. I'm wondering, seeing the United States in the position that you see it now, what can we expect? Would it be 9 years at the earliest that the United States regains that AAA credit rating? How similar are we to other countries that have gone through this?
Of course, we can't predict a future path back to AAA for the U.S. or anybody else. But I can lay out for you, I think, the issues that might cause, lead us in the future to go back to AAA, and they're very clear, and they're based upon our analysis on Friday. If we saw a greater degree of political consensus over fiscal policy and fiscal policy choices going forward, that could be a factor, because we then would suppose that Congress and the administration would come together on fiscal measures that, not only from our standpoint, but I think market participants and everybody else who focus on U.S. public finances would see were credible plans that would stabilize the debt burden over the medium term. And if we saw the two together, then sure, that would at least hold out the possibility at some point in the future the U.S. could go back to AAA.
Well, it's interesting. You're saying in large part politics got us into this, and in large part politics can get us out of this.
Well, remember, fiscal policy and the choices that are made around fiscal policy is fundamentally a political process. And that's one of the 5 pillars of our criteria for rating sovereigns for the U.S. and everybody else.